The financial markets do not operate on hope or innovation. They operate on the calculated harvesting of human collateral. If you are looking at the digital asset landscape in early February 2026, you are not just witnessing a price correction. You are watching a high-speed meat grinder in full operation. In a period of just 6 days, data shows that over $6.7 billion in wealth was liquidated from the crypto ecosystem. To the average investor, this looks like a disaster. To the institutional architects who run the digital pawn shop, this is exactly how the system was designed to work. The concept of the digital pawn shop is simple. You bring an asset like Bitcoin to a platform, you use it as collateral to borrow more money, and you bet on the future. But in the crypto markets of 2026, the pawnbroker also happens to be the person who controls the liquidity of the asset. When Bitcoin plummeted to around $72,000 in early February, it was not a random event. It was the result of a coordinated push that hit the market's most vulnerable point, the retail leverage. According to reports from the Wall Street Journal, the speed of this decline was unprecedented. Bitcoin had been as high as $126,000 in October of 2025, but the retreat back to the $72,000 range has been brutal. This represents a 42% collapse from the all-time high. For Ethereum, the situation is even more dire, with a 56% drop that has left institutional buyers staring at massive unrealized losses. When the Fear and Greed Index hits a level of 14, which is where it stood during the first week of February 2026, logic leaves the room. This is the stage of extreme fear. It is a psychological state where the house knows that retail traders are most likely to surrender their assets. In the digital pawn shop, the goal is not to trade with you. The goal is to liquidate you. Every time a retail trader is forced to sell their Bitcoin at $72,000 because of a margin call, that Bitcoin is immediately scooped up by an institution that was waiting for the price to fall through the floor. In this video, we are going to deconstruct the systemic rot inside the financial markets of 2026. We will look at why Michael Saylor's $76,000 average entry price became a target for short sellers. We will analyze the Senate's secret meetings about market structure and how the United States government became a $15 billion Bitcoin whale, while publicly denying they have the authority to manage the asset. This is the truth about how money works when the system decides it is time for a harvest. To understand the carnage of 2026, we have to go back to the euphoria of October 2025. That was the month Bitcoin hit its historic peak of $126,000. The world was convinced that the 4-year halving cycle was dead. The narrative of the supercycle was everywhere. We were told that because of institutional adoption and the new pro-crypto administration in Washington, the price of Bitcoin would only go up. But as Mike Novogratz pointed out in a leaked interview from that period, markets never bottom where you think they will. Bitcoin was not supposed to act like this. While gold prices were higher and the Nasdaq was stable, Bitcoin broke down through the $100,000 level and never looked back. The problem was that the rally was built on a foundation of paper-thin leverage. Retail traders had used their Bitcoin as collateral to bet on a move to $200,000, and the institutions knew it. By February 2026, the market had crashed $53,000 from that October peak. This drop created a yearly low that sent shockwaves through the industry. The S&P 500 and the Nasdaq were only seeing minor pullbacks, but Bitcoin and Ethereum were in a free fall. This proved that Bitcoin was still being treated as a high-risk asset by the big money, despite the headlines about it becoming a strategic reserve. The technical indicators were equally sketching a dark picture. Bitcoin had lost its 100-week exponential moving average and was heading for a retest of the 200-week line. According to historical charts, every time Bitcoin loses the 100-week average, it retests the 200-week zone. In the 2022 bear market, this pushed the price down to $16,000. In early 2026, many traders were pointing to the $68,000 zone as the potential bottom, but the fear index of 14 suggested that the floor could be even lower, perhaps around $55,000. This is the cycle of the digital pawn shop. The house pumps the asset to record highs to draw in the retail collateral, and then they slowly bleed the price down until the liquidations start to feed on themselves. The $6.7 billion that vanished in 6 days did not disappear into a vacuum. It was a transfer of value from the retail accounts that FOMO'd in at $100,000 to the institutional accounts that were patient enough to wait for $72,000. In the middle of this systemic collapse stands Michael Saylor and MicroStrategy. By February 2026, Saylor had accumulated over 713,000 Bitcoin. His average purchase price, according to public filings, was $76,000. This number became the most important level in the entire financial world. When the market price of Bitcoin dropped to $72,000, the world's largest corporate holder of the asset was officially underwater. The sharks on Wall Street do not look at Michael Saylor as a visionary. They look at him as a liquidation target. Short sellers began pushing hard against MicroStrategy stock, claiming that the management was failing and the company's net asset value was collapsing. According to financial analysts, the current price situation put Saylor in a dangerous position. While he publicly maintained a 10-year time horizon, his stock price was being hammered. There were concerns that stockholders would start to pressure the company to jettison its Bitcoin holdings to protect the core software business. If MicroStrategy were forced to sell even a small fraction of its 713,000 coins, it would trigger a liquidation cascade that would make the $6.7 billion loss look small. This is the cruelty of the system. The institutions know your numbers. They know where your pain point is. By keeping the price of Bitcoin below $76,000 for an extended period, they are testing the resolve of the biggest bull in the market. They are trying to force a capitulation event where the supply of Bitcoin is transferred from a private corporation to the big banks and the government. The irony is that many people still look at MicroStrategy as a good pick to go long. They believe that Saylor has a lease on life and that the company will survive the volatility. But as Bitcoin continues to struggle below the $73,000 mark, the pressure only increases. The digital pawnshop is always looking for a bigger watch to seize, and Michael Saylor is currently wearing the biggest watch in the room. While the retail market was bleeding out in early February 2026, something very different was happening behind closed doors in Washington. The United States Senate was holding secret meetings about crypto market structure. According to data leaked from these sessions, the goal was not to provide clarity for the average investor. The goal was to align the talking points for the lobbies and their mouthpieces in both parties. In a public hearing, the Secretary of the Treasury was asked if American tax dollars would be invested in crypto assets. He stated clearly that he did not have the authority to order banks to buy Bitcoin or to deploy taxpayer money into digital reserves. But then the truth came out. Under intense questioning, it was revealed that the United States government was retaining seized Bitcoin rather than selling it. What began as a small amount of seized assets from $500 million worth of Bitcoin has now grown into over $15 billion. The United States government is now one of the largest holders of Bitcoin in the world. This is $15 billion worth of an asset that the government publicly claims is too risky for its citizens to hold without heavy regulation. This creates a massive conflict of interest. Why would the government want the price of Bitcoin to stay stable when they can use regulatory uncertainty to keep it low while they quietly accumulate more through seizures? As the Secretary pointed out, they are retaining the seized coins as an asset of the United States. To any cynical analyst, this looks like the government is building its own strategic reserve through the back door, while telling the public to stay away from the front door. According to observers like Eleanor Terrett, these closed-door meetings are where the real rules for the 2026 economy are being written. They are deciding which institutions will be allowed to lead the way in tokenized stocks, and which ones will be left to fail. The $15 billion hoard is the ultimate insurance policy for the state. They have the coins, they have the regulatory power, and they have the ability to wait out the retail liquidations. While Bitcoin is the primary focus, the rest of the market in 2026 has experienced an even more brutal purge. Ethereum has collapsed 56% from its peak, leaving many institutional investors who bought in the $3,000 to $4,000 range in a state of panic. Tom Lee and Bitminer are currently looking at a $7 billion unrealized loss on their Ethereum holdings. This is what happens when the digital pawn shop enters a bear market. The secondary assets, the altcoins, are the first things to be dumped to cover the margin calls on the primary assets. Avalanche, for example, dropped to around $9 in early February. This is a level that had been defensible for a long time, but as the price approached the sub-$5 range, the panic became absolute. The last time Avalanche was that low was in early 2021. But in the middle of this altcoin genocide, the house provided a new distraction. Speculative projects like Cardone and its KDN token started to dominate the headlines. Even as Bitcoin was crashing, Reports were circulating that the Clardoon ICO was almost sold out, raising $54 million. There were even rumors that Microsoft or Elon Musk were involved in the background, though these remained unverified. This is a classic tactic used by the digital pawn shop. When the main market is failing, they give you a new shiny object to gamble on. They tell you that a $100 investment in a new token is better than a $10,000 savings account. They use the desperation of the retail traders who just lost money in the $6.7 billion liquidation to lure them into the next trap. According to some community members, the Clardoon project is a millionaire maker because of its burning mechanism. But as we have seen with every other cycle, these projects often serve as exit liquidity for the early investors. While you are betting on a top 5 coin status for a new token, the big money is rotating their gains back into the only asset that actually matters: Bitcoin at $72,000. They are using your hope to fund their accumulation. Despite the carnage in the price of Bitcoin and Ethereum, 2026 has seen a massive push toward the tokenization of everything. This is what the big players like BlackRock and Fidelity are really focused on. They don't care about the short-term price of a coin. They care about moving the entire world of stocks and bonds onto the blockchain where they can control the fees and the transparency. According to industry leaders, tokenized stocks will be the biggest trend of the year. We are already seeing partnerships that suggest a new era of payments. Solana recently partnered with Gusto, a company that handles payroll for thousands of contractors. This partnership means that contractors can now be paid same day with stablecoins. This is the kind of utility that could actually change the economy, putting money in people's hands faster than the legacy banking system ever could. But this transition to a digital economy is being built on the bones of the retail investors who are currently being liquidated. The institutions want the efficiency of the blockchain, but they want to own the infrastructure. They are happy to let Bitcoin crash to 72,000 or 60,000 if it means they can buy up the supply and use it to power their new financial systems. As Michael Burry warned in early 2026, if the decline in Bitcoin continues, it could destroy a lot of value and force even established companies like Tesla to exit their positions. This would create a ripple effect that would hit the S&P 500 and the Nasdaq. The digital pawn shop is no longer a small room in the corner of the internet. It is a global institution that is starting to swallow the traditional financial world. The market structure bills that Mike Novogratz mentioned are designed to provide the legal framework for this takeover. They want regulatory alignment so that global adoption can happen on their terms. They want the rules to be clear so that the banks can safely hold Bitcoin, while the average citizen is discouraged from doing so through high taxes and complex compliance rules. This is how the system maintains its power during a transition to a new asset class. So how does an individual survive a market with a fear index of 14 and $6.7 billion in liquidations? The answer is not in a better trading algorithm or a new speculative token. The answer is in understanding the mechanics of the shop. The digital pawn shop only has power over you if you play by their rules. The first rule is to stop using leverage. Leverage is the oxygen of the liquidation hunt. If you do not borrow money to buy Bitcoin, you cannot be forced to sell. You can watch the price go from 126,000 to 72,000 and back again. And as long as you own the asset in your own cold storage, you have lost nothing but time. Your collateral cannot be seized if it is not in their shop. The second rule is to recognize the patterns of fear. When the headlines are screaming that the 4-year cycle is dead and that Bitcoin is heading for zero, that is usually the signal that the harvest is almost over. The smart money buys when the fear is at a 14, not when it is at a 50. They look for the moments of maximum pain because that is when the supply is the cheapest. According to those who have been in the space for a decade, the fundamentals of Bitcoin have not changed. The halving is approaching in 2 years, and the supply will continue to get tighter. But the market has been papered over by the era of institutional and ETF flows. This has created a new kind of volatility that is managed by the banks. The only way to win is to refuse to be a pawn in their game. The $15 billion held by the United States government and the 713,000 coins held by Michael Saylor are proof that the asset class is here to stay. They are not selling their coins, so why should you? The digital pawn shop wants you to be scared. They want you to believe that the system is failing, so that you will hand over your wealth. In the end, the only thing that matters is sovereignty. If you don't hold it, you don't own it. The events of February 2026 have proven that the House will always try to rig the game. But the house cannot win if you refuse to gamble with things you cannot afford to lose. Stay solvent, stay patient, and keep your Bitcoin out of the shop. Because in the world of 2026, the only true winners are the ones who can wait out the sharks.